Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, and see what people are sharing. If you want to follow me at _finance, and if you want to join our community, findinghighvalue.com, I dive deeper into all these topics, looking for potential investment opportunities and sharing them with everyone in the community. We've got a special going on. Special is the coupon code special, 50% off the first month only, and a larger discount on the yearly membership if you want to sign up or switch into the yearly membership. Mike Zaccardi says JP Morgan earnings per share revisions are nosediving. The price to earnings compression is likely, so we could see further downside in the pricing of some of these stocks. And this is weekly earnings per share revisions are nosediving. And then this is the negative revisions usually lead to a price to earnings compression on that ratio, which means we could go lower, and how assets are being priced with the lower earnings revisions that a lot of companies are projecting in the future. And I'm sure that deals with the uncertainty around tariffs. Um, Maybe they have a direct impact already, or maybe it's the potential impact if what they think they are seeing today stays. Here's Ed, and I want to read this real quick. He says, "No, America, Trump can't replace income taxes on those making under 200,000 with tariffs. Trump is hoping that you do not understand how the taxes work. Entirely removing income taxes for those making under 200K would cost the government approximately 1 trillion in revenue each year. A 10% tariff across the board on all US imports would generate only about 310 billion a year. Even a 25% tariff across the board would only bring in approximately 780 billion a year. And then he goes in and says even a 35% tariff on all US imports wouldn't work because as tariffs go up, imports decline, resulting in less tariff revenue. Remember, tariffs are still a tax on Americans, and they won't want you to tell you that. But my view on this is I don't think we have a tax revenue problem. I think we have a spending problem. I read through this. It's like, okay, this guy is saying, keep spending the same, and this would be your potential income, so to speak, or revenue. I look at it like, let's just start cutting everything. Screw it. Let's cut it all. And I know a lot of people aren't going to like that, but let's cut the heck out of it. Let's go after everything that we can. And I'm sure we don't have a tax revenue problem. It's a spending problem. And then we need to get rid of all these government officials or government people who work for government. We need to go after them if they are unethically stealing through the currency system, through US aid and these other things. Get rid of all of it. Get rid of it all. Now, the problem with getting rid of all that is that we would have to endure a pretty bad recession. That would be the negative side of doing all that. But when I read a lot of these things, a lot of people talk about tax revenue, and I just look at the spending side and shake my head and say, this spending is ludicrous. Absolutely ludicrous. Coming down to the money cruncher, it says, I would never invest in a target date retirement funds. They are way too conservative. For example, Vanguard Target Retirement 2070, which is retirement in 45 years, holds 10.5% of its holdings in bonds. He does not think that that is necessary, and the expense ratios are high, which means how much they charge you. So, in his opinion, I think he's CPA. You can see it up there. He does not like the target funds. They're too conservative, and the expenses are too high. Unusual Whale says, is now a good time to buy a house? And I've answered this over time. We're not waiting for the housing market to break a downtrend line so we can go buy a house. I mean, we're not waiting for the inverted head and shoulders there to get into the housing market. Um, Houses typically don't go down unless you get into a deleveraging phase, which there's only been two. One was in the 1920s and one was in the mid 2000s. Um, the ramifications were house prices pulled back a good chunk. There were certain cities where house prices pulled back quite a bit. I don't know if we're going to get those same market conditions. So when you buy a house, you can always refinance it if you get lower interest rates, if you want to try to lower your monthly payment. And the majority of the lifting comes from interest rates. So the your affordability of the house, the majority comes from low interest rates. Your affordability does. The house price, it can move up and down, but that's not where the bulk of the affordability was lost recently or where it comes from. Now, I can't tell you if interest rates are going to go down or not in the near future. If we get a recession, then interest rates could definitely come back down. And if you bought a house and you got a really nice house that you could easily afford and you really like it, it's in a good location, you know you're going to stay there for probably greater than 5 years, then yeah, I think it's a good time to buy a house. If you're moving around and there's a lot of uncertainty and there's uncertainty around your income, you don't there's uncertainty that you may not live in the city that you're in, then I wouldn't do it. But I can tell you this, a large portion of how I became successful myself deals with locking in such a low cost for my house. That is a huge cornerstone of building wealth. And some people will say, well, you could have rented. And when you did the calculations, that a lot of people do rent and buy calculations today. And even if you did the rent buy calculations when I was purchasing, which was, dang, that was probably almost 10 years ago, they were the same. They looked the same. They're roughly the same. So you look at them and you say, oh, it's not that great to buy a house. I bought a house. I hate dealing with renters. Or I should say, I hate dealing with owners when I'm a renter. I hated it. Absolutely hate it. I'm never going back to renting ever. I hated renting. I'm never going to rent again. I don't care. Either way, I made out so much better buying when I did, refinancing the house in 2021, and my mortgage payment is now about one third to one fourth the price that it would cost me to rent the same house. A third to a fourth is what I pay for my mortgage of what it would cost to rent my own house. So when you look backwards, and let's just say you go 10 years ago and you run the numbers, go 20 years ago, go 15 years ago, run the numbers like you purchased the house in 2007 or 2008 at the peak of the market back then. I'm willing to bet that you would be a huge benefactor of buying the house even during those conditions, even if you mistimed it. And here's another thing to think about. Do you think the value of the dollar is going to go down a lot? The value of the dollar, if it goes down a lot and you have a fixed rate mortgage, it protects you against currency depreciation. In fact, currency depreciation will benefit you on paying your house off as long as you have assets or as long as your income goes up with the depreciation of the currency. So people, when I look out, I'm willing to bet by the time my mortgage is done and I'm paying my last payments, that I'm willing to bet that a nice meal out is going to cost more than my mortgage payment. A nice meal out for the family will cost more than my mortgage payment. When I get to the end of my mortgage payment out in the future, so that'll be like 2050 because I refinanced 2021. So let's say 2050, and my mortgage payment will be it'll be laughable at that point. absolutely laughable. And the rent price for the house is going to be astronomically high. Astronomically high. Time in the market is more important than timing the market. It is literally always a fantastic time to buy, especially with the buyer's market in some market areas. However, a lot of areas are still low supply, high demand, stable growth. We're seeing a big disconnect in the market, the real estate market right now on certain cities are, I think they're good deals. I think there's good deals in Austin, Texas, probably in Florida. I don't know those markets very well, so I'm not pretending like I know them all that well. But I know in the middle of the country, prices are still pretty high, and there's a lot of low supply. So the middle being like Illinois, Kansas, Missouri, Minnesota, like all through the whole Midwest, house prices are still pretty resilient and supply is pretty low. Moving down to trader, this is Cameco. If you took the spinning, I don't need to read all that, but here's the chart. We've got a nice little downtrend line. It's breaking to the upside. This thing looks pretty dang good. And this is the leader for uranium. And I think that we've probably bottomed. Your bottom here was this big bullish engulfing. He's got a spinning top there, but those you only know that looking backwards. But the way that this looks on the right-hand side here, the flag pattern, the breakout, this looks good, and I think we're probably going to go higher. And I think that's for the entire sector. Cameco is our leader. I think uranium's probably bottomed and it's going to head higher. Now, no one knows for sure. Could we do a double bottom where this comes back and does another kind of bottom? It could. And that's the thing. No one knows the future and no one knows exactly where this thing will bottom or not. And I see a lot of people on Twitter. It's like they speak like they know exactly what's going to come in the future. And that's why I think the Lynch approach and Buffett approach is so attractive to me. It's attractive because you're always buying things that are undervalued, which means you're paying less than the value of the company or the free cash flow that they're accepting out in the future. Yeah, there's some speculation on what the company will make out in the future, but as long as you're buying things that are undervalued and you're patient, it makes sense to me. Um, the other approaches and strategies, they don't make as much sense because if you don't know anything about the company and all you're doing is looking at technicals, how do you know you're getting a good deal? How do you know you're not going into a fraudulent company? And looking at the fundamentals, you may or may not be able to distinguish that. If it's something that's very difficult to see in terms of its fraud. But at least you know what you're getting into if you know that a company doesn't have cash flow, or if the company doesn't have any infrastructure, or if a company does have a bunch of infrastructure and you're only paying, 20% of its value, then that's a stinking steal of a deal. And then if you get the technicals to align too on it, then you get that full alignment that I really like seeing. So I think the Buffett approach with a little bit of tech TA, a little bit of market conditions and cycle analysis, I think it'll get you where you need to be. You still have to be patient. You still have to not be scared to purchase when things are cheap. And then you still have to kind of master your own emotions and stuff. But that's the approach I prefer. Now here's Freddy Krueger. I think that's how you pronounce his last name. My expectation. This is his expectation. This guy's a big Bitcoin guy. He says massive shortages in 30 days, recession. Gold and Bitcoin are the only positive assets. Basically, something like 1973. Forget Trump 28. It will be AOC in 28. AOC. Oh my God. Come on, guys. We can do better than this. Um, that's maybe what's priced into the market. I don't know if that's what we're going to get though. Are we really going to get massive shortages? I don't think China produces that amount of stuff. The stuff I don't even buy that much, guys. Like, yeah, I buy some stuff every once in a while. I did buy some. I had to buy two new pans. The ones that we were cooking on a lot, they were yeah, they're pretty nasty. But For the most part, I don't really buy anything, so it's not going to impact me all that much. I mean, I don't even shop at Target really, or I go to Walmart every once in a while to buy a couple of things, but get your oil there. They're usually pretty cheap, but for the most part, I don't really buy that much from most of these stores anyway. So I don't know if there's going to be massive shortages. I mean, I mean, if there's if there's a massive shortage of couches, I mean, it's not gonna that's not the end of the world. Hopefully, a bunch of people buy a bunch of new ones and then they sell them, and I'll buy them used, barely used couches. A Divinology says if you bought a home for 400,000 and the next month someone offered you 300,000 for it, you would say no. So just because the market falls doesn't mean it's time to start selling your stocks. Invest for the long term. I agree with that. And you know, the markets they move so quickly in terms of like stock prices. I think that's where people get afraid. It's the rate of change. And there's some stocks that move pretty quickly. So it's kind of like you see your account value. It's the account value is X. And then over a pretty short period of time, some of these companies can get 30, 40, 50% pullbacks. So you saw X, and then all of a sudden it's zero point 0.5 time X, and you're like, oh my God, that's 50% than what I just saw and got used to seeing a few months ago. I think that's what really shakes people up. So if you can deal with the volatility, that's a huge benefit for any investor. So you have to deal with the volatility if you want big returns. Big returns equals big volatility. A dividend growth investor, it says if you had invested $10,000 in the S&P 500 at the very end of 1999, you'd have $12,308 by the end of 2012. So that's not a huge return. It basically chops sideways. I think that's what's coming in the future. Is we're going to get a big chop sideways in the S&P 500 over like a 10, 11, 12 year period. So I think that's what we're in store, and I think commodities are going to do absolutely insane things. Some of the commodity companies during that 10-year period, some of the really big returners, and these are not small companies, these are decently sized companies, did 100x, 100x from 99 to 2008. Other companies, I saw a lot that did, 5x to 50x. There's a whole bunch that did that, but you have to hold the entire bull market. During that big move, we some of the companies experienced a few 50% plus pullbacks. The hardest time to hold these stocks were in the beginning. The easiest was the end. So if you're buying towards the bottom, it was the most boring and they didn't move as fast in the beginning of the move. And that's where a lot of people are probably going to get shaken out. They're going to say, oh, it's probably a great company, a great opportunity, but they basically get bored and frustrated out of it. Most people don't realize this, but if we ended the Federal Reserve, we wouldn't need an income tax. Imagine that. You'd still receive your same salary, but the only tax would be sales tax on non essential items you buy. That's all you need to fund the government. The whole thing was a scam to rip us off from the start. Getting warmer, getting warmer. If we don't have to pay interest on money that's created, think of how much we would save. Think about that. An income tax started when the Federal Reserve was created. That same time frame. A lot of investors get spooked by volatility. Therefore, they design systems and asset allocations to smooth out the ride. For example, buying fixed income. This costs them in terms of long-term returns, however. If one can ignore volatility and focus on the long run, returns may improve. That's what I'm doing. I'm focusing on the long term, maximizing my total return during this bull market, but volatility is going to kick you in the nuts. It's the way it is. Don't be fooled by the short-term relief. Goldman warns the US dollar is weakening and it is structural. So Goldman is saying, don't be fooled. We've got a structural weakening United States dollar. And then I'll give you other information later. So here's Donald. He says, when tariffs cut in, many people's income taxes will be substantially reduced, maybe even completely eliminated. Focus will be on people making less than 200,000 a year. Also, massive numbers of jobs are already being created. With new plants and factories currently being built or planned, it will be a bonanza for America. The External Revenue Service is happening. Well, we'll have to see. I don't think people pay a whole bunch of money already when you make, say, $100,000 or less. So there'll be a group that may benefit between 100 and 200,000. Once you get above that, I mean, they're the ones that pay all the taxes anyway. So Johnny Oilwell says future U.S. oil supply lies in the chart beneath. To flow, first you must frack. 2024, the average was 250 frac spreads. In 2025, the average is 200 frac spreads. U.S. production will fall. The question is just how much. Hint, it's not a rounding error either of how much this is going to fall. The low prices have impacted the frac spreads in a pretty significant way, which is 25%. Yeah, 20%, be 20%. And we could see a big fall in production here. Paulo Macro says, if you find yourself having to write such things, you actually are creating a confidence problem. It says, we are setting the fundamentals for a strong dollar, a strong economy, and a strong stock market. Investors need to know that the U.S. government bond market is the safest and soundest in the world. And he's just saying if you actually have to state that and tell everyone that, then probably have a problem. Hey, don't worry. It's the safest, strongest in the world. Don't worry, everybody. Cycle investment strategy. Typical pretty much sums up the latest sentiment. Crude oil sentiment is at its lows. And again, that's a good opportunity in my opinion. And I think I talked about this one last time. Let me see here. Yep, I did. So we're going to end it there. That's all I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Specials, the coupon code. And that's all I've got. So we'll catch you next time. This is Finding Value.